So I want to talk to you guys a little bit about preparation. And I also want to thank Nicholas. Nicholas sent me an email with some very disturbing photographs and from inside of a Publix grocery store in Southwest Florida. And we're going to talk more about that later in the video, and I'll show the pictures that were sent in the email and tie that into how it relates to preparation and folks procrastinating and waiting and finding themselves unprepared for life's challenges, which we have experienced just last week. Some of us have in Southwest Florida, Hurricane Ian, others across the country in various different ways. But even more so as the Fed continues to destroy the U.S. economy in its plan, I guess, to build it back better. Who said that before? Anyway, by eliminating millions of jobs, tanking the housing market, creating a reverse housing crisis. As going into the pandemic, there was a housing market crisis with affordability issues, limited supply, increased demand, extremely low interest rates. The money printers were turned on. Now, the reverse, the opposite is happening as they are tanking the housing market, but yet still making it unaffordable through high interest rates. So there will still be an affordability crisis. The demand will decrease. The supply may increase, but the supply may actually remain the same as builders will pull back from building and sellers will pull back from listing, because the buyer pool is going to be changed drastically. Now, with that being said, I've actually had conversations with homeowners who are panicking, who are unfortunately devastated and deeply afraid of what is going to happen next. And it all comes back to the Fed. The Federal Reserve. You'll see Jerome Powell make announcements. He'll be on the news. He'll be on other channels. Check out Clear Value Tax. Brian Kim is actually putting together a series to provide updates and information from the Federal Reserve, the monetary policy and plan that they have to pretty much wipe out the stock market, wipe out the housing market, wipe out the crypto market, because the Fed controls it all. The Fed runs the money printer, and depending on the money in circulation, the money taken out of circulation, quantitative tightening, quantitative easing, interest rates, Fed rates, buy rates, prime rates, adjustable rates, the Fed is behind it all. Mortgage interest rates, credit card APRs, which is a huge problem. I don't want to get off topic here. I don't want to get off track, but someone actually emailed me yesterday and asked if I could recommend a good credit card for them, because the only one that they were able to get approved for had an APR at 39.99%. I mean 39.99%. If we wanted to do the math, you would have to see that every dollar charged on a credit card with 39.99% would cost you so much that it would nearly be impossible to pay it off by making minimum payments. It would really, the rest of your life, you would be in debt to this credit card, which we're probably going to see a lot of credit card defaults and more bankruptcies as the Fed continues to hurt the U.S., the middle class, lower income families that are relying on credit, that are relying on credit cards, that are relying on loans. But we'll talk about that in another video. I'll maybe even put together a list of credit cards, credit card options, lending, funding options. If you guys are interested, just drop a comment and let me know. I'll put it at the top of the list. Now, so the email that I actually received was about the housing market and fear. Actually, I'm sorry, conversation that I was having with someone. And basically what it boiled down to is, because of what's going on with the Federal Reserve and how they're adjusting interest rates up continuously, month after month after month, 75 basis points, consecutive increases, which honestly, I would not be shocked to see them go up 100 basis points or even more for the next, depending on where the CPI inflation reports come in. I would not be surprised if they went up 100 basis points or more, and just go ahead and rip the Band-Aid off. Now, ripping the Band-Aid off is going to hurt a lot of people. It's going to hurt a lot of businesses. It's going to hurt a lot of families. It's going to be a devastation. So as far as preparation goes, while we're having this conversation, while you're listening, watching this video, you still have time. Now, the conversation was of devastation for the fact that this homeowner is now looking for options and bailouts and safety nets and a plan B and a strategy. And they thought they had a solution through equity. Now, typically, you know, the equity in your home is it's wealth that you have acquired, that you have built through real estate, which is the beauty of real estate. Real estate is one of the best wealth building tools out there. Now, at the height of the pandemic, housing prices were going up. Homes were being sold for over asking, all cash offers, waiving appraisal contingencies. It was unbelievable. It was a seller's market. It was crazy. Well, what that did was, with every home that sold, it created a new comp. And that new comp drove up the values of homes in the surrounding areas. So even if you didn't plan to sell your home, you still saw a positive increase in equity as a result of the comps around you, which some people used for to leverage, and others didn't. They kind of just sat on it. And I was actually having a conversation with someone who's fallen on hard times. They're a homeowner, but they've fallen on hard times. And they actually reached out to their bank to inquire or apply for a loan, is a home equity loan or a home equity line of credit, HELOC, HELOC. And their bank actually told them, they denied them. The bank told them, they said, we are temporarily pausing, we are temporarily freezing any applications for home equity loans, home equity credit. So that was a huge blow to them. They said that when they heard that, when they got that response back, that their hearts sunk. So they've moved on and they've reached out to other lenders. They found a couple that are still offering these loans against home equity values. But here's the kicker. Here's the problem. There's multiple problems here, but the big problem is that now, because of the actions that are occurring with the Federal Reserve and their plans and strategies to try to fix the economy and lower inflation, interest rates have gone up. So with the interest rates going up, and this applies to credit cards too, that's why we're seeing these crazy high credit card interest rates, and it makes borrowing money so expensive. Auto loans are going up. Auto loans now are like 6%, 7%, something crazy like that. So just let you guys know, don't borrow money if you don't have to. It's too expensive. So the Fed has raised interest rates. So now for anyone interested in going the route of a home equity loan or home equity line of credit or HELOC, that loan that you're going to take out against your home's equity is going to cost you more to repay because the interest rates went up. So that's the first problem. The second problem is, because of this, the Fed's goal is to slow the economy and bring down home values. Now, granted, if they bring down home values, it would theoretically make them more affordable. But for the average buyer looking to finance with a 15 or 30-year mortgage, it costs more because the interest rates are higher. So it doesn't necessarily help with the affordability aspect if you're looking to borrow to buy a home. Now, with that being said, as the home values come down, when you apply for a line of credit or a home equity loan or HELOC, guess what? your home's value has been reduced. The comps around you are going down. They're getting older, they're becoming stale, and your home value is being reduced, thus lowering the amount of equity that you could have available to borrow against. That a lot of people are now finding out the hard way, that even if they can find a lender willing to participate, the amount of equity has been reduced and the interest rate has been increased. Mainly for the fact that these lenders are not super excited about lending against the equity of a home where they're seeing a possible drastic crash, collapse as this bubble deflates the housing market. They don't want to be overextended. They don't want to be over leveraged in these loans. They don't want to do that. And so it's creating this tight space of fear where people's backup plan and their safety net and what they thought they were going to use to be prepared for whatever is slowly being reduced and ultimately like totally eliminated. Because most lenders, I believe, will cap you at 80% of your value. So let's just say, let me see if I can do this quick math in my head. Let's just say you have a $500,000 home value worth $500,000. So they would say that 80% of that value, so 10% would be 50 grand, so 20% would be 100 grand. So that means that they would take that 20% off the top. So they would say, all right, your home is worth 500. We would allow you to borrow up to 400 because we're only going to allow you to borrow up to 80% of the home's value. Okay, cool. So you got a $500,000 house worth $500,000, appraises at $500,000, which these home equity loans and these home equity lines of credit, these HELOCs, they require appraisals too. So we're not going on stated values or Zillow's estimates or anything like that. So if it's worth $500K, if it appraises at $500K, they're willing to loan up to $400K. Now the question is, how much equity do you have in that home? Because if your principal mortgage, if all the liens against that property, your mortgage is a lien against the property. If all the liens against that property total up to or beyond $400,000, then guess what? That equity that you have between the 400 and the 500 is great, but no lender is going to allow you to access it because they're capping it out at an 80% value. All right, so let's just say you owe $300,000. Great. You have the ability to borrow $100,000 of your equity from that home and fall within that criteria. But the kicker is going to be that you're paying a higher interest rate to borrow that $100,000. And again, the limited possibilities and likelihoods of finding lenders out there willing to take on that risk is being reduced exponentially day after day after day, especially as Jerome Powell and the Fed continue to release new updates and new statements about the economy, inflation, interest rates, their position, not to mention, global impacts as we're seeing China possibly dumping the US dollar and, Japan and the UK falling into their monetary crisis and having to turn on the money printers to print more money, basically lowering the value of money, further increasing inflation and putting everybody into this tight little bind here. Like I said, you got to rip that Band-Aid off. But the problem is this is being unprepared. This is not smart. So these are things that were going on at the height of the pandemic when opportunities were at their greatest and people were sitting back thinking, oh, this will be fine. There's nothing to worry about. When at that time, when the rates were lowest, when the values were highest, when the appraisals were coming in, that would have been a good time to capitalize and access your equity. And now you're finding yourself in a position where that's not even really possible. So with that being said, don't procrastinate. Don't waste time. Don't be lazy. Don't be silly. Much like the photos that I'm going to show you here of the Publix in Southwest Florida and people now attempting to access these grocery stores and stock up on the food and supplies that they need now after it's too late. They are unprepared. They're seeing the results of their lack of preparedness and are probably kicking themselves thinking, why didn't I do this sooner? Why did I wait till now? Now there's nothing left. Now there's nothing I can do. My family's at risk. The shelves are empty. There's nothing here. There's no water. There's no chicken. There's no eggs. There's nothing. What am I going to do now? Not much you can do now. All you can do is sit back and say, I wish I would have did something sooner. I wish I would have did something earlier. I hope this isn't you. But if it is you, take this as your warning sign. Take this as a indication, key indicators we talk about in previous videos, that it's time to get your butt in gear, prepare financially. There's going to be financial preparedness is going to be probably the most important prep moving forward, besides any others, for the next 2, 3, maybe 4 years. Natural disasters aside, those are, kind of outliers, but the financial prep is going to be the most important prep that I could tell anybody for the next couple, 3, 4 years, especially as our economy continues to go down. The Fed continues to try to wrangle this bull to the ground, and we see families get wiped out and shut down and ultimately forced into poverty as a result of lack of preparedness. Don't let it happen to you.